Before I start, I'd like to say a quick thank you to our sponsor, Fidelity International. You can find out more about them at fidelity.co.uk/money to the masses. Hello and welcome to Damien's Midweek Markets, the show where I talk about what's going on in investment markets and what to look out for in the days and weeks ahead. So what a week it's been since the last show. Now last week I asked the question, are we near the stock market top? And since then, the market has basically imploded. Don't blame me. I was just pointing out the likelihood of it happening. So since we had that video, the market has fallen. If you look at the S&P 500, for example, 7.6% in a matter of days. It was almost, as we published that video, just hours later, the market turned. The FTSE 100 fell by the same amount. It's now down about 7.6%. It's sitting below the key 7,000 level. The S&P 500, as I mentioned, also fallen, is now down around 3,128. The DAX has fallen almost 10%. That's correction territory, down to 12,763. The Euro Stoxx 200 is below its 200-day moving average, which is a key level that people who look at technical analysis will look at because it shows a fairly bearish outlook. The S&P 500 is below its 100-day moving average. The VIX, the fear index in the market, is up above 25. It's rocketed from where it was last week. Now, tech stocks, which have been driving the rally of the last few years, have actually fallen into correction territory. So that's down 10% since last week. Apple, which is one of the key drivers of the S&P 500 and global stock markets, to be honest, is down about 12%. On the flip side, if we look at haven assets, so bonds, the yield on the 10-year US Treasury has fallen from 1.66 down to 1.35. That's an all-time low. Gold has rallied 5.2% in the last week to a 7-year high. So what we're seeing is this rotation from equities into haven assets. So why has that happened? And the key answer is the coronavirus. So the coronavirus has spread outside of China now. We've had hotspots in Iran, in Italy. We've had America warn that they're probably going to have an epidemic. So they've warned the general population that there is a likelihood that there's going to be an outbreak in the US. All of this has caused great uncertainty and has caused investors, equity investors in particular, to start to focus on fundamentals and economic growth prospects. So ultimately, it seems like equity investors have finally caught up to what bond investors have been saying for quite some time. It could be argued that the virus is just an excuse for investors to catch up with bond markets on the outlook for global growth and also earnings growth of companies. As the outbreak of the virus increases and spreads around the world, and if we get a pandemic, it's hurting supply chains globally. So we could see more fallout going forward. Interestingly, if you look at a sector level on equity markets, the story is quite different. It's quite varied. So defensive sectors have held up relatively well. So that means utilities and real estate investment trusts, REITs, have been holding up relatively well compared to other sectors which are more exposed to the economy. So cyclical sectors, so financials, for example, have underperformed. Now, if you've been listening to these videos, you'll know my 50k portfolio has been exposed to those defensive sectors. And that has largely been down not just because of the virus, it's been due to the momentum that's been building up in those sectors, as there's been increasing concern about the outlook for the global economy. The virus is almost an excuse for the rest of the equity market to catch up with what the bond market has been saying and what gold has been telling us. So should we be panicking right now? Well, the message should be that diversifying your portfolio is important. So if you're worried about what's been going on in equity markets, then it's a sign you've been taking too much risk, more risk than you are actually comfortable with. So the answer is to diversify more. So that means holding assets that behave differently, which are bonds and equities and things like gold. But the big question on everybody's lips is, when will this sell-off end that we've had? Now, as I make this video, markets are trying to break back up again because they've fallen quite hard and quite quickly, as I say, breaking key levels. If we take the S&P 500, for example, we want to be breaking back above 3141 to show some sort of signs of an upward trend resuming. And really 3,300 is a key level in the S&P 500. If we get back above that, then we break back above the uptrend that started back in October when the Fed started loosening its liquidity levels and started to push the markets higher with its not QE4. So we want to see the market pick up. On the downside, we want to keep an eye on the 200-day moving average on the S&P 500 and the 3,100 level. Around that area, if we break down below that, that will be a negative sign for the market generally, and I mean not just the US market, but global market. So we've got a real fight on our hands at the moment when we look at equity markets. Now, I want to finish this episode on a positive note because I could just focus on the negatives. I could sit there and reel off a whole load of numbers about the size of the sell-off in different markets, and it could be quite depressing. But if you had a fairly balanced portfolio, say 60% in equities, 40% in something like bonds, then what you've seen in the last week is you would have seen your portfolio fall in value, but only wiping out all the year-to-date gains that you've had. So it's not sort of catastrophic as yet. And also, if you think about it, the last 2 days we've seen on the New York Stock Exchange, we've seen 90% of the stocks fall and be in negative territory. So that is quite a severe sell-off, and the breadth has been very negative. But the last time, or every time in fact, we've ever seen that phenomenon, then within 2 months, the S&P 500 has been up 7.8% on average, or over a year it's been around nearly 25% up. So you often get a rebound from times like this. It doesn't mean that history will repeat exactly, but it often rhymes. So in the coming days and weeks ahead, what you want to be doing is keeping an eye on the breadth of the market, especially when we start getting an uptrend, and when that resumes at some point, is it being carried by just a few stocks, or the sell-off, is it accelerating? Is the breadth of the sell-off widening? Are more stocks falling through their 100-day moving averages, their 200-day moving averages? And the other thing to keep an eye on are the headlines around the coronavirus. You don't want to react to them, but obviously at some point we hopefully will get some positive news, and especially the economic numbers that are coming out. That will make a massive impact on what the market thinks is going to happen to the US and the global economy. And of course, the market is already starting to price in the Fed loosening policy, so start cutting interest rates at a quicker rate than had previously been planned, because global banks will have to step in if it looks like we're going to enter a global recession. And if they do, then history suggests that should be positive for the stock market, but we'll have to wait and see. Now, that is it for this week on Damien's Midweek Markets. As ever, you can contact me, Damien at moneytothemasses.com is the email address. Money to the Masses with a number 2 is the Twitter. You can find us on Instagram and you can find us on Facebook. Don't forget to join our Facebook community where you can ask questions on anything, not just investing. And of course, subscribe to our YouTube channel.